Attendees are in listen-only mode.
Good evening, everyone. Welcome to Annual Markets webinar of 26th of March 2014. Today again we have a webinar about money management, of course, because it's a very important subject. And once again we will have a nice view of money management strategies, why you shouldn't go with martingale strategies, and basically why you should go always with your risk. So, of course, before we begin, our risk disclaimer and online educational materials are developed by Admiral Markets Estonia for a global audience. Therefore, please take into consideration that the information in this session may not be suitable for everyone. To get a corresponding information on charting, conditions, and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Also, this disclaimer explains all the risks associated with Forex market, and by proceeding further, you agree with all risks explained. Admiral Markets UK Ltd takes no responsibility for the information accuracy. The analysis represents the personal opinion of the author, it's me, and in no way it represents the actual suggestion for the trade. These are not AM UK's opinions. The website in the video is not the .co.uk website, but the globaluse.com website. Forex is risky business, and this is personal opinion, and this webinar is for informational, educational purposes only. Today's agenda, we will talk about money management, about leverage, different examples of various trading styles, how trading firms do it, martingale, blackjack, and bonus MM script. So once again, and this is for final time and the last time, I will give you this after this webinar. I will give you the link to download this bonus money management script. I will explain how it works, and with this webinar I think that you should conclude your knowledge about money management, and that you should know about generally how you should trade intraday, swings, scalps with your money management. Of course, we will have many other webinars, especially in May, concerning how you can turn your scalps into intraday trades, how you skillfully can do it. I will show you the little tricks in Forex market, how you can do it. But also, I need to tell you that this webinar, and we will have another webinar called Compounding. I will teach you how you can make investment out of Forex market. So basically, we won't have so much webinars about money management, as I hope that you have already learned how money management and risk management is important. So for final time, again, money management tripod, always remember, guys, successful trading is based on tripod. It's a profitable trading strategy, systematic approach based on technical and fundamental analysis, risk management called money management, and trading psychology. If one leg falls, all will fall apart. So for the final time, this slide, which I've been showing you so many times when we had webinars concerning money and risk management and psychology, remember this slide once and forever. Profitable trading strategy, risk management, and trading psychology is what you need to become a profitable trader. They are all very dependent on each other, and if one leg falls, everything will crumble. So again, set 3 tasks. First task for you is not to lose a capital and stay on the flow for many years. This is your most important task. Again, once and for always, remember this. This is your primary task, not to lose a capital and stay on the flow for many years. That means that if you want to trade, you need money. If you don't have the money, you won't have a trading opportunities. How you can trade without money. Second thing is gradually multiply your equity figures. And third thing is earn profits. The problem with many people is they set a third task for the first place, and that is the main mistake in Forex market. If your primary goal is to earn profits and not to lose a capital, then you will lose. So this should be your primary task, this is your secondary, and the tertiary task is to earn profits. Success comes down to proper risk management. That is what you need to remember, guys. So remember these slides, because one of our last money management webinars in this form is this one, and of course next will be compounding. This is totally different subject, so pay attention to it. In upcoming months we will have webinars concerning Heiken-Ashi strategies, range bar strategies, turning scalps into intraday position trades, and so on. And money management, I hope that you have learned it. Today we will go through it and I will summarize it all up. Concerning leverage, because this is our next subject, is I recommend, this is my recommendation, no more than 5-to-1 leverage. For example, if the account balance is $5,000, it's not much for Forex trading, but even that is enough for you to make profit. So don't trade with more than 2,500 per positions, 2 mini lots or 0.25 NT4 lots. So let's talk in MT4 lots. If you have 5,000 USD dollars, US dollar account, you should trade with 0.25. For $10,000, I recommend 0.5. Of course, having in mind that your average stop loss is around about 30 pips. So basically, I will show you the table, what the recommended lot sizes for scalps, intraday positioning trades or swings, and you will see how I have come with that calculation. Don't ever risk more than 2 to 3% per trade. So for example, if the stop is 30 pips, we will use the following formula. Stop loss times the leverage divided by 100%. So you know, in mathematics, first you need to calculate which comes in parentheses. This comes first, then you divide it by 100%. So in this case, it's 30 pip stop loss times 5, because the leverage is 5-to-1, divided by 100, and it's 1.5% of a risk. I need to mention that again, that after this webinar I will give you the link so you can freely download money management script, which will be very, very handy to you. I will also show you how you can use it. Try to trade with 0 to 2 risk to reward. Try. I don't say it will come always, or it will come to this risk to reward. But you need to remember that money management is maybe the most important thing, because even though if you have a good system and good trading psychology, if you don't know to use money management, that will be a fail. So in these market conditions, which are today, not today, just last couple of years, they are very unstable and volatile. Even if you trade with 0 to 1-to-1, sorry, it's okay. If you have a good method and a good trading psychology, mind of a trader. But be sure to have at least 60-40 win to loss ratio. So even then, if you have 60-40 win ratio, if you go with 1-to-1, you will be good. Scalping, what is scalping? You know, scalping is a way of making quick profits, and usually when scalping, you want to exploit fast movements of the market, and it's usually done on 5 and 15 minutes time frames, except for some extremes with 1 minute scalping. Usually when you scalp, risk is based on overall risk per trade and per day and risk per trade. So let's say that we have a risk of 3% per day, and account is $10,000. Now watch the table. If your account is $10,000 and you want to have 3% of a risk per day, basically if you use one lot to do your 3% maximum risk, you can have with only a 10 pip of stop loss 3 trades maximum. I don't like 10 pip stop losses. They usually will be hit, especially if some news is gonna happen and is about to come. So don't go with 10 pip stop loss. Even if you scalp, you need a little bit more of a stop loss. So let's say that you won't still go with 10 pip stop loss because your system told you to do that. Then if you go with one lot, you can have 3 trades maximum once, or 3 trades maximum total. So you basically are risking $300 per all of trades, or $100 per one trade. Now, if you go with 0.5 with 10 pip stop loss, you can have 6 trades maximum. And now let's say that you are going with a normal scalping, let's say 5-minute scalps usually use 15 pip stop loss. Then if you go with one lot, you can have 2 trades maximum. If you go with 0.5 lot, you can have 4 trades maximum. And you know that already that you're basing, yes, it's the same. Basically, it's not just completely the same with Euro account, because I think that on Euro dollar pip value is around 7 euros. But basically, you can count that easily with the method I told you. So basically, you just, or it's the same, because I will give you the calculator after the webinar, so it will be the same. So what I recommend, guys, this will save you. You will remember that in a couple of years, probably, that if you use this kind of money management, even if you have a losing streak, if the market is not very good to you, you still can save your account. You still can have great trades because you are not risking much. Now, ask yourself, would you rather risk so much that you can have a lot of money in one single night, or you want to risk that you want to have a risk so low that you maybe will be a millionaire during, or maybe in next couple of years, or in next 10 years? Maybe you won't be a millionaire, but you will still have the money to trade with. The problem is, if you are risking always on, let's say, on $10,000 account, and if your fixed stop loss is 30 pips, because your system tells you that stop loss is 30 pips always, then basically if you go with one lot, you will be risking $300. It's 3% of a risk. It's too much, because if you lose that single trade, it won't give you the chance to recover. But if you go with, let's say, 0.5, you will have still a chance to recover and to fit into that 3% of maximum risk. So in this example above, we see that 0.5 lots seem optimum for scalping the account of 10K. So for each 10K, we raise our volume traded for 0.5. So on $20,000 account, it's good, and you can safely trade with one lot. If you have a $1,000 account, then you have to use 0.05 or 0.1. My trading style fits into the 3% of maximum risk per day. Usually it's below. It's usually 1 to 2%. Sometimes I can have 3% of maximum risk. So that gives me a potential of 4 to 6 consecutive losing trades, which is very hard to happen. Now, if you go with intraday trading, that means that you are trading basically on 1 hour or 4 hour time frames, usually making entries on lower time frames if you go with multiple time frame trading. What is multiple time frame trading? That means that you usually go with daily and 4-hour trend, and you take entries on 1 hour or maybe 15 minutes. So intraday trading is basically intraday positioning. You usually make entries on lower time frames, or let's say one single time frame, and you want to exploit a daily trend. Usually that will mean 1 trade per session per pair, of course. So this should be per pair. So one pair can give usually one trade per session, or sometimes you can have 2 sessions per trade if you close your position during London session and you want to take also position during New York session. Usually stops used range from 25 to 50 in recent market conditions. So let's say that you have an account of $10,000. Your risk is again 3% maximum, and maximum number of losses sustained is if you use one lot for trading and you put 25 pip stop loss, that's basically you're risking $250. Again, I will remember you that your trades are always based, and your trading should always be based on how much are you willing to risk, not how much you will gain, because you don't know whether you will gain, because forex is risky and that is a speculative job. You need to enter your trades based on how much you are willing to risk. So if you're willing to risk 3%, again, with a single lot and 25 pip stop loss, you can have only one trade maximum and one scalping trade with $50 of a risk. With 0.5, you can have 25 pip stop loss and basically 2 trades maximum plus one scalping trade. Now with one lot you can have $500. Does it fit in? No, it doesn't fit in into 3% of a chance. That is also how traders lose money. If you're willing to risk 3% and you make one lot of trade and put 50%, 50 pips of stop loss, and maybe you don't even use stop loss, it won't fit in and it will be a losing trade. 0.3 is basically the best option for intraday positioning of $10,000 account, because if you use 50% stop loss, you're basically risking $150 and you can have 2 trades. But even then, those are intraday positioning, and even if you lose, you won't lose much. But if you lose one lot of 25 or 50%, you're basically done with your trading for that day. And then that means that if you want to have multiple trades per day, per let's say a time frame, so if 0.3 lot is your maximum size, then that 0.3 should be split evenly between 3 trades. So you will basically use 0.1 on 3 of those trades with a 50 pip stop loss for each one. Again, going with proper money management will save your life in the long run. Making 2 to 10% per month with risk, which is way above these figures, is not recommended. I don't recommend it at all, because you need to make, if you are serious enough, you need to strive to make 2 to 10% per month. But excellent result is always 2 to 5% constantly with a low drawdown. I will tell you what ideal trading is later. You can check it also by yourself. So if your method is 70% successful, you don't need to have 2-1 reward to risk. It can be even 1-to-1. Now, I will give you a friendly advice. You already know that we trade with Admiral Markets. Well, I trade with Admiral Markets, and most of us do also. I know that many brokers use fake tactics to suck you into trading, giving you false promises of quick profits. If you hear that brokerage or saying to you that can be very unloyal concurrent, that competition, and you should always stay away from it, because unloyal competition is the worst thing it can happen in forex market, because you may lose the money before you even take a trade. So that is the case with bad brokers, with bucket shops, with many of those firms which are not regulated. Forex is not for a quick making of a fortune. You cannot be very rich if you trade instantly, if you trade forex properly, But Forex is a long-pace marathon where you are basically a long-distance runner. So you need to fit into that 1 to 2%, maybe if you have experience within 3% of maximum risk, and then you will be okay. You will still have the money to trade. Even if you lose, you know you won't lose forever. There will still be a chance for you to basically make profits and reverse your trading account. The only problem is which pair to trade and when to trade. So having a good method will tell you which pair to trade and when to trade. Now about long-term trading, that means, you know, most of us don't do that. I never did that because I'm not a weekly trader, I am an intraday trader. And I need to tell you that long-term trading involves trading on weekly and monthly charts. It's suitable only for investing the money. It's very hard to grow the account with only long-term trading. Why? Because many natural disasters or many misfortunes which can happen during the weekend or during the month can reverse your account from profitable one to a losing one. You know that weekly charts use stop loss of approximately 350 to 500 pips, while monthly stop loss levels are 1,000 to 2,000 pips on some pairs. So Forex trading on $10,000 would require a lot of patience. One candle is minimum 7 days of waiting for weekly and 30 days of waiting for monthly trade to go on. So it also questions risk to reward, as long-term charts are very prone to various economical disturbances and shifts. And there have been numerous times when some influential banks such as Danske Bank made a prognosis on monthly movements, then changed it after some time. So with account size of $10,000 and risk of 3% of maximum, basically all you can have is 0.1 to 0.05 lot on 350 stop loss. 0.1 even it doesn't fit in. It can be traded, but it doesn't fit in perfectly within a 3% of a risk if you use basically weekly or monthly candles. So pay attention to these tables. Optimally on 350 pips stop loss you can have one position open and maybe one intraday trade. Weekly and monthly are just definitely not my trading style. Now take a look at those two tables, and you're probably all of them, you're smart ones, and you're basically, because you're probably traders, I think that you're smart people, and judging by this picture you can easily tell how money management is to the utmost, it's utmost importance. It's so important that I cannot express myself how important is that. Just take a look at those two tables and look, risking 2% of total account per trade and have 10 losing trades in a row, and risking 10% of a total account per trade with 10 losing trades. Now, if you take a look at these tables, it's easy to say which trading style you should chase. Of course, you should chase this trading style because after 10 losing trades, this account is only 17% in a drawdown, and the other account would be over 60% of the account. The thing is, usually it's not about your system, it's not about the market. Usually it's about you, your trading psychology, and your trading in general, because you probably didn't have a plan when you trade. So as you know, you should always have a trading plan when you trade. You should not trade blindly. You always need to have a trading plan. So if you want to intraday trade, with, let's say, $10,000 account with 3% of a risk, which is indeed a higher percent of a risk per day, you can safely go with 0.3 lot. One lot with 50 pip stop loss, just you should never think about it. Even one lot with 25 pip stop loss should be avoided because you can only have one pair, one trade maximum. Now, how trading firms do it? Usually principles of work, organization in a proprietary trading firm are they have analysts, because I have traded with a trading firm some time ago and I know how it's done. They have an analyst, they have a trader, and they have a risk manager. Now, the analysis business is to search for trading ideas, do a market research, and make trade analysis. Then the analyst presents his work to a trader, and then afterwards trader makes his decisions about entry size, stops, profits, etc. Analysts check the pairs, give suggestion to a trader, and a trader carries on with the job. Now, risk manager usually controls the risk. At the start of each trading day, he analyzes the potential risk. So if a company profits from markup and commissions, he calculates needed lot size and presents it to a trader. Usually trading firms do have a markup. They also earn money by commissions. And the job of a risk manager is to calculate those lot sizes and commissions and presents it to a trader. Trader is a soldier. He pulls the trigger. And it's basically the same like it's in a military. Strategists make the plan and soldiers carry on with the plan. So the general is usually a leader on the battlefield. The trader is a soldier. And risk manager is a support. Now, usually trading firms do not trade as this way, and I knew that some traders did that early back in the day, and even now some traders basically do that Martingale strategy, which is basically derived from a casino's blackjack. If you ask me what I think about Martingale and about casino blackjack, I told you everything in this slide. The loser usually doubles up the bet in order to win back. How I call it, it's called, maybe it's not the same as revenge trading, because revenge trading is a psychological thing. In revenge trading, you will usually double up your size, but you will go with you won't go with technical trade. You will go with psychological trade, and you will probably lose the money. But if you use a proper strategy, you can double up the bet. It's not the case within Martingale. There is a strategy of self-destruction. So, similar to casino's blackjack. Now, according to Martingale's system, gambler or trader should double his bet after every loss and return the bet to initial amount with every winning bet. Now pay attention to this. If gamblers bets $10 on red, if he wins, he bets $10 again. If he loses, he bets $20 on red. Now, if he loses again, basically he will bet 40. So with every time when he loses, he will double up his basically trading volume. He will double up his potentially a good trade. He will use more risk. And now the problem is the gamblers, I call them gamblers, not traders. They don't have an infinite amount of money. If the gambler had an infinite amount of money, he would be always winning, because his next bet will not only return his losses but will guarantee a win over the initial bet. Now, while all Martingale systems fails, because in reality gamblers and traders don't possess infinite funds. Who possesses infinite funds? Even George Soros do not have that. So infinite funds are basically impossible to have, and a losing streak of 10 rounds will require a bet of 1,024 initial bets, or $10,240 if your initial bet was only $10. So pay attention to this. A losing streak of 10 rounds. It can happen because you are basically using a martingale. So you can have a losing streak of 10 rounds. Theoretically, you can have it. But you will need basically $10,240 if your initial bet was 10 to recover from losses. 20 rounds long losing streak will require a million of 48,576 initial bets. Now, stay away from this. Do not listen, this is my opinion as always, do not listen to ones which tell you go with martingale. In the long run, you will lose, you will burn out your account. Because if you start with $10 and you have basically a losing streak of 10 rounds, then you would need to have $10,250. But if you have 20 rounds of losing streak, it will require more than a million. Okay? So that is a very, very bad business to do. That is not business, that is gambling. Now, always try to pay attention on yearly yield versus maximum drawdown. So you need to decrease lots traded because if the system goes against the market, the trades which you have will be losing. So you can risk only with affordable part of the capital. If you are not sure, then don't risk. What is the evaluation of risk? It's a ratio between the yearly yield and the maximum drawdown. So yearly yield is 60%, maximum drawdown is 15%. Consequently, the ratio is 60 divided by 15 is 4. Anything more than 3 tells for the good trading results. So always compare yearly yield versus maximum drawdown. So if your yearly yield is 50% and your maximum drawdown is, let's say, 3%, that will give you basically a result, a perfect result of 16 point something. And remember, anything more than 3 tells for the good trading results. You can check your maximum drawdown also with trading, with your statements of MT4 and the broker which you use, but you can also check it with myfxbook.com. So yearly yield and drawdown, you can see this table, every result which is bigger than 3 is considered a great result. Now, additional advices before we move on to indicator and calculator. I will give you additional advices, and you can think about some questions if you have the questions. For a beginner, stop loss should not exceed 1% from the client's equity. So, guys, if you are beginner traders, don't use more than 1%. I know that you try to make money, that you try to be great traders and so on, but remember, if you're a beginner, your stop loss should be not more than 1%. Daily loss limit should be 2 to 3 stop losses. Weekly loss limits not more than 5 to 6 stop losses in a row. The less trades you make, the better is the result. On the first trade, it's best to limit the maximum amount of orders placed per day. The secret of success is losing trades should be closed fast, profit should flow. So stop loss and using stop loss will slow the ruining time of your account and give you the time to compensate for it and give you the chance to turn your account into good direction. Now, this is the most important thing which you should always remember, even if you're a beginner or a pro trader. Your risk is always based on how much you can afford to lose, not how much you think you will gain. So your risk is always based on how much you can afford to lose, not how much you think you will gain. Because the only thing which is for sure is how much you can afford to lose. That is the sure thing. But you don't know how much you will gain. Now, this is an excellent money management indicator. And at this link, I will also share you this link. Let me remove it like this. So this link will give you basically an excellent tool for money management. This is excellent tool. So Admiral, you can see the link, and basically you can download money management calculator for builds 600 and plus. The latest is 625 builds. This script should be put into MQL scripts folder. You should put it on your desired chart, and it will look like this. So risk percent column is the risk percent that you are willing to risk. So if your risk is 0.5 per day per trade, just put 0.5. Enter your stop loss in pips, and it will automatically calculate proper lot size for you. So it doesn't matter how much you have on your account. It will always base your entry lot size on how much you're willing to lose. So if you're willing to risk 3% in a single trade, then it will calculate. If you're willing to risk only 0.2% in that particular trade, it will calculate the proper lot size for you. So as I told you, this is basically one of the last webinars we have about this kind of money management, because next time when I talk about money management, I will be talking about compounding and how you can make your investment if you want to, for your future, if you want to go with compounding. Also, I need to tell you that you can try many different systems, many different strategies, but the ultimate success will eventually come with using proper money management and proper strategy, which can give you the chance to trade all of those pairs, 23, 24 pairs, not just 3 or 4. So again, slides for scalping, slides for intraday trading, and for basically long-term trading. So money manager script link is this one. I can also write it down for you so you can take that great script and it will help you. I will share the link with you also. admiralfiles.s3.amazon.com calculator.ax4. And when you download the indicator, you can place it into a script folder. As I said, for 625 current build, you should put it into MQL scripts folder and then put it on your desired chart. And it will calculate the risk size for you freely. So guys, if you don't have any further questions, we can refer basically to our future webinars. Yeah, a question. Hello T, thank you for the Euro Aussie setup. Worked great for me. Excellent. I have a question. What are your thoughts on instant market execution modes? So market execution modes are great. Why not? Especially if you do market orders. Market execution modes are almost a necessity if you scalp, They are very, you need to be quick for, so basically if you want to scalp, you need to use market orders. But if you want to do intraday positioning trades, if you don't want to wait, you can also put pending orders. I personally use more market orders than pendings, but from time to time I also use pending orders. So about market orders, just avoid those market orders when there is a big volatility, let's say, for example, ECB conference or Fed conference or something like that. You should avoid trading. But the slippage is usually possible on the market execution. Well, it's how can I say, it's not a big of a slippage. Basically, if the market is moving very fast, then you can have a bit of a slippage, because you will get the price what you see on the screen. So, but it's very how can I say, it's almost invisible, and it's very, even if it's slippage, it's very low, maybe 0 point something, and I go with market execution, market orders. So basically, don't be afraid of slippage. You need to be afraid when there is big news. So let's say that the market is going up, and you want to long. You want to make, let's say, a trigger happy breakout trade. Then you can have a, worse price. But if the market is slow and it tries to reach your target, let me describe this for you. And then I have also a question asking, can I show the slides again? Of course. Let's say that the market that you want to buy, the price here at this point, and the price is slowly grinding down to this point. And when it reaches this point slowly, it's very safe to go with market order. But if you want to take that level, and you see that there is a big news which raised the volatility of the market and price start dropping like this, then if you enter there, you would probably have some sort of slippage. So don't go with market orders if price goes fastly like this or fastly like this. But if it grinds slowly to your entry price, then it's very safe to go with market order. But even then, if you experience some slippage with breakout trades, it won't be that much. Now, a good question. Why do I always close a trade too early in profit? I don't wait for TP. How to lose the fear of taking full profit? Is it just time and experience? Good question. How you use, basically, it's not just up to you. And this was the question I will show you. This was the question. I need to say that it doesn't solely depend on your psychology and yourself. If your method tells you to use trailing stops, then it's easier for you to use trailing stop after 12, 15, 20 pips in a profit than to too early close the trade without making any profit or with making a very small profit. So usually what you would like to see is you want the price to grind slowly towards your target, and then when it hits your target, you can go with that trend. After that, you need to wait for possibly, let's say, 12, 15, 20 pips, and then if it hits your target price, you're okay to go. If it doesn't hit, use trailing stop, or try to use a script with automatic trailing stop, which will move your stop loss with every 10, 12, 30 pips of a profit. That is always how I usually do it, and it can be very good strategy if you want to experience a full force of those kind of trading. So if you ask me, I would always go with trailing stop, and rarely I would go with a full price potential without using a trailing stop. It's just the way I go with Forex market, and it's usually a very safe way to go to use trailing stops. Otherwise, you should stay away from your trading platform. Don't be too close to your monitor, and don't look too often on your charts, because usually then you will be making those early profits. So it depends on your trading method, trading style. If your trading method allows you to use trailing profits, then use it. But if you're not sure when or where, don't do it. Just put your stop loss, go away from your platform, and then, I don't know, if you're trading on 1 hour time frame, take a look each hour to see where the price went. But don't babysit your trade. That is how I would recommend you to do if you don't want to have that fear in your head, that kind of fear in your head. So guys, this is the answer to your questions. I personally use, with Camarilla MACD, I use trailing stops. Prior to inception of Camarilla MACD, I didn't use trailing stops. But now, in these market conditions, and because I trade 23 pairs, I need to use trailing stops. If you use only, I don't know, euro dollar, and if you trade GBP dollar, then, well, what I can say, if your method allows you to use it, then use it. Usually you will use trailing stops on higher time frame trading, not on scalping, and surely not on those small sessions. You need to use it usually on big movements and big swing trades. One more thing to add, if you've been following my Aussie dollar today, now it's a good place to use trailing stop, because we are basically at the end of the session. I will show you, you probably remember that. Here is daily analysis. What did I tell you? My advice, of course, how I traded is to take trades near this POC1. Pay attention, we had a trade here, and now it's the end of the session. Market has gone some 15 pips into direction, so I would maybe use trailing stop now, because the market will surely be slowing down. So guys, now is the time for you to use that trailing stop. If you want to use it, now it's a good time. If you want, then don't do it, of course. So let's get back to this slide. So for scalping, this is it. For intraday trading and for long-term trading slides. And guys, if you don't have any more questions, of course, pay attention to these blogs. Daily analysis for Australian dollar. Today we had that analysis. Also, let's see, I will show you, we had analysis for Euro 3C. We also had analysis for, let's see, it's a bit slow now. I also made analysis of euro dollar, and this is my view of euro dollar. So pay attention to blog, Admiral Markets blog and Forex Factory, because usually on these blogs I will be making update to trades. Look at my last 2 months of trading, basically with full exception of Camarilla. That is also my gift to you. I'm making an analysis for all of those pairs, and you can see how I traded all of those pairs. 4 trades: CAD, Japanese yen, Aussie, Australian dollar, New Zealand, Australian dollar, yen, So I don't trade just 2-3 pairs. I trade all of those pairs. So be sure, of course, to sign in for premium webinar. I will be explaining MT4 Bill 625 and MACD two-line custom indicator. I will tell you what changes have been made in MT4 Bill, but these premium webinars are only for live holders of Admiral Markets account. Live account holders, only for them. Then, of course, weekly Forex recap. Be sure to sign up. Live trading lab with Chris, and of course, we will be having basic Forex strategies for beginners. Price action webinar trading part 4. You will see some counter trend trading, and with that we will conclude price action trading, because we are at the end of price action. We will be doing counter trend trading. It's a little bit maybe complicated because it will use a lot of candlestick patterns, a lot of swings, but you need to pay attention for that. Price action trading part 4. And of course on next month, and then we will have range bars, we will have Heiken Ashi candlesticks trading methods. I will show you that also. So guys, with that we can conclude our webinar. I hope that you have enjoyed it, and pay attention always to your risk and money management, because it will save you, it will save your account. Even if you have losing streaks, it will save your account. And just don't go with that Martingale and all those styles, because you don't have infinite funds. Okay? Doubling up losses are a bad thing to do in Forex market. So thank you very much for listening. Thank you very much for paying attention. Tomorrow expect new analysis during London and during New York session. And of course, full updates on Admiral Markets blog. Thank you, and I wish you a very good evening. Cheers, everyone.